The global oil reset is no longer theoretical. It has begun. And despite how it is being framed in headlines, this is not fundamentally a political drama or a temporary geopolitical flare-up. What is unfolding is structural. It represents the early stages of a systemic reordering of the global oil market, initiated at a single geographic pressure point, but designed, intentionally or not, to ripple through energy flows, pricing mechanisms, and power structures across the world. This moment must be understood through one central principle. When control over oil shifts, everything downstream shifts with it. Transportation costs, food prices, industrial margins, inflation dynamics, and even monetary stability all trace back, directly or indirectly, to energy. Oil is not merely a commodity. It is the base layer of the modern economic system. Any meaningful change in who controls supply, production, or distribution constitutes a global shock by definition. At first glance, the trigger appears abrupt. The United States moves decisively into Venezuela, a country that holds the largest proven oil reserves on Earth. Geopolitical tension spikes, narratives multiply. But beneath the surface, a deeper mechanism is activating. Venezuela is not being repositioned because of ideology or symbolism. It is being repositioned because it represents the single largest pool of dormant oil capacity in the global system. Venezuela has long occupied a paradoxical position. On paper, it should be an energy superpower. Its reserves exceed those of Saudi Arabia and dwarf those of the United States. Yet for years, it has functioned not as a producer of influence, but as a broken asset. Vast oil wealth sits underground, inaccessible due to collapsing infrastructure, outdated technology, capital flight, and prolonged isolation from global markets. Oil that cannot be reliably extracted, refined, and transported does not confer power. It remains latent, and latent wealth attracts intervention. The shift underway is not simply about asserting influence over territory. It is about targeting the bottlenecks that have kept Venezuelan oil from re-entering global markets at scale. Pipelines, refineries, logistics networks, financing structures, and corporate access are the real levers of this reset. Once these levers begin to move, the oil market does not adjust gradually. It recalibrates. Supply expectations change first. Those expectations move futures markets. Futures move prices. Prices then propagate outward into inflation expectations, trade balances, and monetary conditions. This is why the phrase global oil reset is not hyperbole. It is descriptive. Modern energy conflicts are not fought primarily with tanks. They are fought with contracts, sanctions, access rights, and control over supply chains. Venezuela is not the endgame. It is the lever. Control over Venezuelan oil is not just about extracting value. It is about denying access to rivals, reshaping trade routes, and reasserting dominance over a commodity that underpins global growth. Markets understand this instinctively. They are already reacting not to what has happened, but to what has become possible. If credible operators regain access, if production ramps over time, and if Venezuelan supply re-enters global circulation under new management, the long-term implication is clear: downward pressure on oil prices. But markets never move in straight lines. Before supply stabilizes prices, uncertainty dominates. Geopolitical tension injects fear. Fear creates volatility. Volatility defines every reset phase. This is why the oil reset will not look orderly in its early stages. It will appear chaotic, contradictory, and emotionally charged. Oil is embedded in everything. A change in Venezuelan output does not remain local. It transmits through shipping costs, industrial production, consumer pricing, and household budgets. Investors, governments, and institutions are watching, not because they care about a single country, but because they understand that oil resets cascade. Timing amplifies the impact. The global economy is already fragile. Debt levels are elevated. Central banks are constrained. Supply chains remain vulnerable. In such an environment, a major energy realignment acts as an accelerant. It forces repricing, exposes weak points, and rewards those who understand structure rather than headlines. Venezuela represents one of the most extreme paradoxes in modern economic history. The largest proven oil reserves on Earth paired with one of the weakest operational capacities. This contradiction did not emerge overnight. It is the result of decades of structural decisions that transformed a potential energy powerhouse into a resource-rich but operationally broken state. Oil alone does not create power. Power comes from execution. Efficient extraction, reliable refining, consistent transport, and scalable distribution are what convert reserves into influence. Venezuela lost these capabilities long before the current crisis. Nationalization displaced expertise. Capital exited. Maintenance collapsed. Infrastructure decayed. For a time, high global prices masked the damage. Eventually, the decay became undeniable. Sanctions compounded the problem. Financing dried up, equipment imports slowed, technical partnerships vanished. China stepped in not to rebuild Venezuela's oil sector, but to secure discounted supply. Output stagnated. Decline continued. Venezuela became a supplier of distressed oil, not a competitive producer. This is why Venezuela is best understood as the most powerful broken asset in the global energy system. Broken assets attract intervention because they represent unrealized value. Markets have always mispriced Venezuelan oil because the constraints were political and technical, not geological. Once those constraints are challenged, repricing becomes inevitable. The current shift signals exactly that challenge. The focus is no longer ideological, it is operational. Infrastructure can be rebuilt, pipelines repaired, refineries modernized, supply chains reconnected. This does not require decades. Markets move on anticipation. The moment credible actors commit capital and expertise, expectations shift. Expectations are the first phase of every reset. Historically, Venezuela produced over 3 million barrels per day. Today, output is a fraction of that. The gap between potential and reality represents millions of barrels the market has written off. Reintroducing even a portion of that supply alters global dynamics. This is why Venezuela matters far beyond its borders. Control over this reactivation also shifts negotiating power. When a country cannot monetize its own resources, leverage migrates outward. Control follows capital and expertise. In this sense, Venezuelan oil becomes a strategic variable in a broader contest over energy dominance. The economic logic driving the U.S. move is straightforward. Oil markets are governed by a simple rule. Whoever controls marginal supply controls price direction. Venezuelan oil represents one of the largest pools of marginal supply on the planet. Unfreezing it reshapes the global supply curve. This also functions as a macroeconomic lever. Energy prices flow directly into inflation. Lower oil prices ease pressure on consumers, stabilize input costs, and create policy flexibility. In an era where monetary tools are politically constrained, energy supply becomes an indirect but powerful stabilizer. Volatility is not a side effect of this reset, it is the mechanism. Markets reprice through instability. Futures swing on anticipation. Leverage amplifies emotion. Short-term spikes coexist with longer-term downward pressure. This whipsaw environment punishes rigidity and rewards adaptability. The consequences extend beyond oil. Energy prices influence currencies, fiscal balances, and geopolitical leverage. Countries dependent on high prices face stress. Consumers gain relief. Power redistributes. China's position highlights this shift. For years, Venezuela functioned as a discounted energy source secured through isolation. As that isolation erodes, so does China's advantage. Control over infrastructure determines access. If operational dominance shifts, preferred buyers become displaced buyers. This is how modern energy competition unfolds quietly, structurally, and without spectacle. The oil reset, therefore, doubles as a power reset. It reasserts control over energy flows and constrains rivals indirectly. Markets understand this even when public discourse does not. Ultimately, the oil reset is not just about barrels and prices, it is about redefining the conditions under which modern economies operate. Scarcity narratives are giving way to control narratives. Execution is replacing ideology. Capability is replacing assumption. This is not an ending, it is an opening. The reactivation of Venezuelan oil marks the first visible adjustment in a broader transformation. Once the assumption of permanent constraint breaks, the entire structure of expectations changes. Capital reallocates, strategies shift, the global system adapts. The reset is already underway, and its consequences will extend far beyond oil charts, reshaping inflation, money flows, and the balance of power in the global economy for years to come.
Hello, my dear friends, welcome back. Today, new video. So, friend, the global oil race is no longer theoretical, it is begun, and despite how it is being framed in headline, this is not fundamentally a political drama or a temporary geopolitical flare up. What is unfolding is strategical. It represents the early stage of a system recording of the global oil market limited at a single geographic pressure point, but this can intentionally or not to wrap through energy flows, pricing, and power struggle across the world. This moment must be understood through one central principle: when control our L shifts, everything downstream shift with it. Transaction cost, food prices, and retail mergence, inflections, prices, and still and dynamic and even monetary capital all trace back directly or indirectly to energy. Oil is not merely accommodated, it is the base layer of the modern economic system, and change in who controls supply products or distribution countries a global shock by definition. At first glance, the trigger appears abrupt. The United States moves dizzily into Venezuela, a country that holds the largest foreign oil reserve on earth. So, friend, this is very informative video. So please, very like and very shares, WhatsApp group shares and Facebook group pages shares. Thank you.